In early January 2026, something happened in the silver market that most people completely misunderstood. Silver prices pulled back sharply after one of the strongest rallies in decades. Headlines immediately called it a correction. Some even called it the end of the silver boom. But for anyone who understands how real markets work, this moment didn't look like an ending. It looked like a signal. Not a signal of collapse, but a signal of stress building beneath the surface. Because markets don't move in straight lines. They move in waves. And when something has been climbing as aggressively as silver did through 2025, a pause is not only normal, it's necessary. The real question isn't why silver dipped. The real question is, what kind of market creates a dip like this after such an extraordinary run? To answer that, we need to step back and understand what actually changed in silver over the last few years. For more than 40 years, silver was considered a disappointing asset. It had moments of excitement, but every time it approached major levels, it failed to hold them. Investors learned to expect disappointment. That belief became embedded into market psychology, and that psychology kept silver suppressed for decades. But markets change when fundamentals change, and fundamentals around silver have changed dramatically. The first change is supply. Silver is not like gold or oil, where production can easily respond to higher prices. Most silver is produced as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply does not rise just because silver prices rise. So when global demand starts rising faster than production, shortages begin to form quietly, long before headlines appear. That's exactly what has been happening. For multiple consecutive years now, the world has consumed more silver than it produced. That gap hasn't closed. It has widened. At the same time, silver's role in the global economy has shifted. It is no longer just a precious metal or a hedge against inflation. It has become a critical industrial input. Solar energy requires silver. Electric vehicles require silver. High-performance electronics, data centers, medical equipment all require silver. This means silver now sits at the intersection of finance, technology, energy, and geopolitics. That's not a normal commodity position. That's a strategic one. And markets behave very differently when a material becomes strategic. Now combine that with what's happening globally. Governments are spending aggressively. Debt levels are historically high. Inflation is no longer considered temporary, and central banks are trapped between protecting currencies and protecting economic growth. This creates a world where trust in paper systems becomes fragile, and whenever trust becomes fragile, demand for tangible assets increases. Not because people are panicking, but because they are rebalancing risk. Silver benefits from this shift, because it is one of the few assets that is both a monetary hedge and an industrial necessity. That combination is rare. Now let's talk about the price behavior itself. In 2025, silver didn't just rise. It broke through levels that had rejected it for decades. That matters more than the percentage gain. Breaking a multi-decade resistance level changes how institutions model risk, how funds allocate capital, and how long-term investors perceive the asset. Once that psychological ceiling is broken, the old price memory stops working. The market enters what traders call price discovery. That phase is unstable, volatile, emotional. Prices move fast, pullbacks are sharp, and narratives flip constantly. That doesn't mean the trend is fake. It means the market is trying to figure out what silver is actually worth in a world where its role has changed, and that process is never smooth. Now look at what's happening outside price charts. Physical silver inventories have been declining globally, not on one exchange, but across multiple regions. When physical inventories drop while paper trading remains liquid, that creates a divergence. The financial market says silver is abundant. The physical market says silver is scarce. Those two cannot stay disconnected forever. Eventually one forces the other to adjust. Historically, when physical scarcity becomes severe enough, paper markets reprice violently. That's how commodity shocks happen. Not from hype, from inventory stress. Now look at Asia. Industrial production there is massive. Solar manufacturing, EV production, and technology infrastructure are expanding rapidly. These sectors don't care about silver's price narrative. They care about supply security. If you are building solar panels or electric vehicles, you cannot wait for a dip. You need metal. Period. That means some buyers are not price sensitive. They are availability sensitive. That kind of demand creates structural pressure. It doesn't leave the market easily. Meanwhile, Western financial markets remain focused on short-term signals, interest rates, inflation reports, central bank language. Those things matter, but they are surface forces. The deeper force is this. Silver has become embedded in the physical infrastructure of modern civilization. That gives it a floor that didn't exist before. So what does a pullback really represent? It represents a moment where financial traders take profits, reduce exposure, and rebalance. But it does not erase industrial demand. It does not refill depleted inventories. It does not reverse multi-year supply deficits. So the dip is not the story. The structure is the story. And structurally, silver today is not the silver of the 1990s, the 2000s, or even the 2010s. It is a different asset in a different world. That doesn't mean prices go up in a straight line. It means volatility becomes the norm. And in volatile markets, emotional investors lose money. Patient investors survive. The biggest mistake people make is thinking markets move based on fairness or logic. They don't. They move based on pressure. Pressure from supply, pressure from demand, pressure from policy, pressure from fear, pressure from necessity. Silver now sits under all of those pressures at once. That makes it uncomfortable, confusing, and extremely powerful. So when you see silver drop after a historic rise, don't ask, is it over? Ask something more important. What kind of system creates both explosive rallies and sharp pullbacks at the same time? Because that's where the real story lives. Not in price, but in tension. And silver is currently one of the most tension-filled assets in the global economy. That doesn't guarantee profits. Nothing does, but it does mean silver is no longer boring. It's just being misunderstood.